Good morning, candidates. Turnover ratio, stock turnover ratio or inventory turnover ratio is equal to cost of goods sold during a year divided by average inventory. Average inventory is calculated by adding inventory at the end of each month of the year divided by 12. Or if data is not available, it may be calculated as inventory position at the beginning of the accounting year plus inventory at the end of the accounting year divided by 2. Interpretation: this ratio signifies the liquidity of inventory. Higher the ratio indicates quick sales, whereas low ratio indicates blockage of funds in inventories. Debtors turnover ratio, credit sales divided by average receivables. In case the data on credit sales and month-wise receivables position is not available, the ratio can be calculated dividing total sales to receivables. Interpretation: higher the ratio indicates that debts are being collected quickly. The ratio helps in cash budgeting since the flow of cash from customers can be worked out on the basis of sales. Calculation of holding periods. Holding period norms were evolved in the year 1974 when Tandon Committee report prescribed a standard holding period for different units for use by banks in India. However, later on, RBI suggested that holding norms may be consulted for guidance purpose only, and banks were made free to evolve their own standards for assessment of working capital. Raw material holding in periods and days. Average stock of raw material divided by annual consumption of raw material into 365. Stock in process holding period. Average stock in process level by cost of production into 365. Finished goods hold period. Average stock of finished goods by cost of goods sold into 365. Debt collection period in days. Average receivables by sales into 365. Creditors payment period in days. Average outstanding creditors divided by annual credit purchases into 365. Average inventory or receivables or creditors are calculated by adding their levels at the end of each month of the year divided by 12. Or if data is not available, it may be calculated as the position at the beginning of the accounting year plus inventory at the end of the accounting year divided by 2. Or the outstanding position of these items at the end of the accounting years may be considered. Annual consumption of raw materials is calculated as operating stock of raw material plus purchase of raw material minus closing stock of raw material. Cost of production is raw material consumption plus stores and spares consumed plus power, fuel plus factory labor plus repairs and maintenance plus depreciation plus other operating expenses plus opening stock in process minus closing stock in process. Cost of goods sold is calculated as cost of production plus opening stock of finished goods minus closing stock of finished goods. If the figure of annual credit purchase is not available, annual purchase figure may be used to calculate this. Thank you.